Rocket Lab's Q2 2026 earnings are in, and, well, it's a mixed quarter. Revenue beat consensus at a record $234.07 million, so that's up 62% year over year. But EPS missed the mark, coming in at a loss of 7.08 per share versus the expected $0.06 loss.
Right.
Q3 guidance points to another revenue record somewhere between $250 and $265 million, but with contracting margins. And the stock reaction. Shares slid nearly 7% in after hours, trading to around $74.49, which basically erased some of that pre-earnings momentum.
Yeah, if you step back and look at the big picture, I mean, this is classic aerospace growing pains. You have a company bringing in cash hand over fist on the top line, but they are burning it just as fast to build out their physical infrastructure.
Exactly.
And, the market had priced in near perfection after the stock rallied over 40% from its July lows. When you have a trailing price-to-sales multiple pushing 72x heading into an earnings print, any slight EPS miss and, softer forward margins, they're going to trigger an immediate sell-off.
Yeah, the valuation simply didn't leave room for the margin compression management just guided for.
It really didn't.
Okay, let's unpack this. Because to figure out exactly why the stock reacted the way it did, we really have to look under the hood at where that record $234 million in revenue actually came from. And honestly, this is where the quarter gets incredibly lopsided.
Extremely lopsided.
You look at Space Systems, and it generated a massive $189.5 million. That is up nearly 39% sequentially from Q1. But then you look at Launch Services, the actual rockets.
Right, the namesake.
Yeah, and they generated just $44.6 million. That is a 30% decrease sequentially, even though they completed a similar number of launches in Q2 as they did in Q1. So for a company with rocket in its name, their launch revenue just shrank by a third while satellite systems absolutely exploded. Are you investing in a launch provider or a satellite manufacturer at this point?
Well, what's fascinating here is how the accounting mechanics are completely obscuring the actual operational success of the launch division. That 30% drop in launch revenue isn't a failure to execute. It's an accounting reality, really, driven by a massive shift in who is actually buying their rockets. They're transitioning from point-in-time commercial launches using their standard Electron vehicle to overtime defense contracts using the HASTE derivative.
Oh, right. HASTE.
Yeah, HASTE stands for Hypersonic Accelerator Suborbital Test Electron. It's essentially a modified rocket used by the defense sector to test hypersonic payloads.
Wait, so instead of getting a $10 million check when the rocket successfully clears the tower and reaches orbit, the government is essentially drip feeding them cash based on project milestones.
Exactly. That is the percentage of completion accounting method in a nutshell. With a standard commercial flight, the revenue hits the books in one massive lump sum at the time of launch.
Which is nice and clean for the balance sheet.
Right. Very clean. But these national security and defense research contracts, they are highly complex, multi-year, multi-milestone agreements. You pass a critical design review, you get a percentage of the revenue, you integrate the payload, you get another percentage.
I see.
So even though the physical launch cadence remains completely steady, the cash and revenue are smoothed out over a much longer duration.
Which means the top line for launch looks artificially depressed this quarter. It's not that they're flying less, it's that the money is arriving on a totally different schedule.
Exact.
But, that still doesn't explain the sheer scale of the Space Systems revenue. Almost $190 million in a single quarter is a massive leap.
Yeah, that leap is coming from pure manufacturing scale combined with inorganic growth. They are ramping up production on massive satellite buses for the government. And crucially, they also got an initial revenue injection from the newly closed Mynaric acquisition.
Right, Mynaric.
Mynaric specializes in laser communications. In modern space architecture, satellites don't just talk to the ground using radio waves anymore. They talk to each other in orbit using lasers.
Wow, okay.
Yeah, it creates a secure, high-speed mesh network in space. So integrating Mynaric's financials into the Space Systems segment immediately boosted that top line.
That feels like the real aha moment for anyone holding this stock. Rocket Lab is quietly using its launch business as a loss leader, or almost like a Trojan horse, to build the real moneymaker, a dominant, vertically integrated space infrastructure monopoly.
That's a great way to put it.
They get you in the door with a cheap, reliable rocket, and then they sell you the satellite, the laser communications, the solar panels, the flight software, just everything.
And that is exactly how you have to value the business going forward. You are investing in an end-to-end space prime where the manufacturing arm is rapidly outpacing the original launch business in terms of raw revenue generation.
So they fixed the revenue recognition issue and Space Systems is booming. But booming revenue usually means booming profits. Why did they actually lose more money per share than Wall Street expected? Which I guess brings us to the margin compression and the cost of all this M&A.
Right. The acquisitions aren't free.
Exactly. The $8 EPS miss was directly caused by $8.6 million in M&A transaction costs. I mean, they closed the Mynaric and Motive Space Systems acquisitions in Q2, and they announced historic pending takeover of Iridium Communications.
Yeah, and those M&A transaction costs, they hit the income statement immediately, acting as a direct drag on the EPS. But, if you're an institutional investor analyzing the after-hours tape, you aren't really panicking over a one-time $8 million fee.
Right.
The bigger systemic concern is the margin trajectory management just guided for.
Yeah, let's put some numbers to that. Q2 non-GAAP gross margin was actually very healthy at 41.5%, but Q3 guidance projects a significant drop down to somewhere between 35% and 37%.
A pretty steep drop.
And plus, operating cash outflow was $134.4 million in the first half of the year alone. Here's where it gets really interesting.
Yeah.
They are buying up the space supply chain aggressively. But acquiring companies to bolt onto your operations is like trying to stitch two different nervous systems together.
That's a brutal process.
It is. I mean, it's like buying a fully furnished house instead of building the furniture yourself. It saves time, but you have to pay the movers, and those transaction fees hit the bottom line. You've got Rocket Lab software, Mynaric software, different HR departments, different supply chains, and until they all speak the exact same language, you're bleeding efficiency.
Yeah, that friction is the hidden cost of aggressive expansion. The margin compression we're seeing guided for Q3 is entirely about the mechanics of integration and scaling.
Okay.
When you acquire a company like Mynaric, you inherit all of their operational inefficiencies until you fully digest them into your own ecosystem. You have redundant IT systems, overlapping administrative costs, and massive capital expenditures required to align their manufacturing lines with yours.
It's expensive.
You're literally paying for two distinct corporate infrastructures while trying to force them to operate as one.
And surely it's not just the acquisitions dragging down the margins. I mean, they have their own internal production to worry about. They're scaling up major satellite production lines, specifically for the Space Development Agency's Tranche 3 program.
Oh, yeah, and the physical mechanics of that transition are just brutal on near-term margins. Rocket Lab is moving from building bespoke one-off satellites where every unit is a custom engineering project with high margins,
Right.
to operating a standardized assembly line for a massive constellation. When you make that pivot, your initial gross margins always tank. You're hiring hundreds of new technicians, you're physically optimizing the factory floor for continuous flow, locking in bulk supply chains.
That takes a while to smooth out.
It takes several quarters of high-volume production before the unit economics actually start to yield higher margins.
Well, that explains why non-GAAP operating expenses for Q3 are projected to rise significantly, expected to land somewhere between $121 million and $127 million. They are spending heavily to build the factory machine that will eventually print the cash. But Wall Street isn't valuing them as a charity project.
Yeah.
The market looks at a drop from 41.5% to 36% gross margin and hits the sell button, effectively ignoring the fact that this is the necessary cost of scaling a defense manufacturing operation.
Which is a classic disconnect between short-term quarterly expectations and long-term industrial strategy. Management is willing to take this short-term hit because they are executing a massive vertical integration strategy.
And going all in.
They are. They're pivoting away from being just a niche launch provider and attempting to become a Tier 1 space power.
And the pending Iridium deal is the absolute crown jewel of this pivot. It completely changes their DNA. They go from being a hardware vendor, someone who just builds the satellite and launches it for someone else, into a global constellation operator delivering communications capabilities directly to the end user.
It's a huge leap.
And the market demand for this end-to-end capability is clear. Their backlog just hit a record $2.36 billion. That is up 137% year over year. They've already signed over $1 billion in new contracts in Q3 alone.
The top-line numbers are staggering. They really are. But if you look at the composition of that backlog, the defense sector is now the primary engine of their growth.
Right.
They just secured a $397 million Space Force SBAMTI contract. That stands for Space-Based Airborne Moving Target Indicator.
Okay, break that down for us. What does an airborne moving target indicator actually do?
It's exactly what it sounds like, but from orbit. The Department of Defense wants to be able to track moving assets like aircraft, drones, or ground convoys continuously from space, rather than relying on vulnerable radar planes like the AWACS.
Makes sense.
And crucially for Rocket Lab, that $397 million contract is for both the launch and the spacecraft. They're providing multiple Flatellite spacecraft and launching them on their upcoming Neutron rocket.
Wait, I want to pause on flatellite. We hear that term thrown around a lot. Does it just mean a flat satellite? Why is that revolutionary for their margins?
It changes the entire launch equation. So traditionally, a satellite looks like a giant, bulky washing machine covered in solar panels. It takes up a massive amount of volume inside the rocket's payload fairing.
Right, lots of wasted space.
Exactly. A flatellite is engineered to be as thin as possible so you can stack them like pancakes inside the rocket. If you can stack 10 satellites in a single launch instead of 3, you drastically reduce your launch costs and accelerate the deployment of the entire constellation.
Oh, wow.
Yeah, and on top of the SBA-MTI win, they also secured another $160 million to build 3 GEO, meaning geostationary equatorial orbit satellites. This represents their first real foray into GEO satellite production for the U.S. government.
So they are building these massive flat-packed constellations and deep space GU assets, but they're also backing up all this orbital hardware with entirely new ground infrastructure.
Yeah.
They introduced the Ghost Deployable Launch System on this earnings call, which is debuting in Alaska in 2027.
The GHOST system is fascinating.
Yeah, it allows them to support suborbital and orbital launches from anywhere in the world. But why does the Department of Defense need a launch system on wheels?
Well, the GHOST system is a direct response to the Pentagon's demand for tactical, responsive space access. Think about the physical vulnerability of our current space infrastructure.
It's pretty static.
Very. If a major geopolitical conflict breaks out, the military doesn't want to wait 6 months for a scheduled launch window at Cape Canaveral or Vandenberg, which are prime targets anyway.
Right.
They want the ability to roll a mobile system out to a remote location like Kodiak, Alaska, and put a critical communications or surveillance asset into orbit within 24 hours. And Rocket Lab is building exactly that capability.
So what does this all mean? If you're an investor looking at that $2.36 billion backlog, you might think this company is a sure thing. I mean, they have government backing. They are buying companies like Iridium, Mynaric, and Motiv. But because of these acquisitions, they now have over $600 million in goodwill and intangibles sitting on their balance sheet.
That's a big number.
Yeah. If I'm looking at the risk profile, what happens if these new defense contracts and these massive corporate acquisitions don't mesh perfectly?
If we connect this to the bigger picture, Rocket Lab is now one of only 2 vendors trusted with this Launch Plus spacecraft capability for national security. They are in the absolute elite tier alongside companies like SpaceX.
Wow.
However, the execution risk right now is exceptionally high. Converting a multi-billion-dollar backlog into steady, predictable cash flow requires flawless manufacturing execution and supply chain management.
And if they stumble, what is the actual trap for investors here?
Well, if they stumble on the manufacturing floor or if the acquired businesses underperform, the company faces severe impairment risks on those intangibles. That $600 million in goodwill is essentially the premium they paid over the actual book value of those acquired companies.
That's basically a hope premium.
It is the hope premium. If Iridium or Mynaric fail to generate the projected cash flows they promised the market, Rocket Lab will be forced by accounting rules to write down the value of those assets. Yeah, that results in massive non-cash charges hitting their income statement, which can completely wipe out profitability for quarters, if not years.
Which brings us to the linchpin holding this entire $2.36 billion valuation together. Because to launch these massive new constellations, to fulfill these defense payloads profitably without paying a competitor, and to deploy the Iridium assets, Rocket Lab desperately needs their next-generation medium-lift rocket, Neutron, to fly.
Neutron is the entire ballgame for their launch economics and their profit margins.
The update we got on this earnings call is that Neutron's Stage 1 tank production is targeting a Q4 2026 delivery to the launch pad. The maiden flight is broadly expected in late 2026 or early 2027. And, to be fair, they have the cash to get there. Their liquidity is historically strong at $2.39 billion in cash and marketable securities.
It's a massive war chest.
It is, but we have to talk about how they got that cash. A huge chunk of that, $1.53 billion in net proceeds, came from a massive at-the-market equity offering. meaning they essentially printed new shares and dumped them straight onto the open market to raise that $1.5 billion. They diluted the very retail investors who pumped the stock. How are retail investors not rioting over that?
Well, because the institutional side of the market understands it was a necessary dilution. That equity raise secures the balance sheet, it funds the Iridium acquisition, and guarantees the runway for Neutron.
I suppose that's true.
If they hadn't raised that capital while the stock was surging, a single major delay in Neutron's development could have triggered a liquidity crisis.
But retail investors are getting antsy. You look at the sentiment on retail boards, particularly places like RKLB on Reddit, and they are hyper-focused on Neutron delays. I mean, they are literally analyzing grainy photos of the factory hardware, debating the colors of the tape used on the rocket components.
The tape color.
Yeah, arguing whether green tape means a routine structural test versus black tape meaning an engineering mistake. It sounds absurd, but it highlights a massive information asymmetry in aerospace investing. When you can't see the financials of the new rocket yet, you are forced to become a forensic manufacturing analyst just to figure out if the company is on schedule.
That's incredible.
So at a trailing PS multiple of 72x before this earnings drop, can retail investors stomach a Neutron delay into 2027, even with that massive cash pile?
This raises an important question about the divergence between institutional patience and retail expectations. The $2.39 billion war chest essentially removes near-term bankruptcy risk. It fully funds the Iridium acquisition and guarantees they can keep the lights on even if development stalls for a year.
Right.
But that premium stock valuation, that 72x sales multiple, is entirely tethered to Neutron entering commercial service on time.
Because the current rocket, Electron, just doesn't move the needle enough on its own anymore, right?
Yeah, Electron is fantastic for small, bespoke payloads, but the real margins in the launch business come from medium to heavy lift vehicles like Neutron that can deploy multiple large constellation satellites at once.
So it's a bottleneck.
Here is the physical bottleneck. Any delay in Neutron's engine qualification or setbacks in that Stage 1 tank integration directly defers high-margin launch revenue. And more importantly, it bottlenecks Rocket Lab's own satellite deployments.
They'd be stuck.
If Neutron is delayed, they physically can't launch their own stacked satellites. They either have to pay a premium to launch their SB-AMTI defense satellites and their Iridium payloads on a competitor's rocket, like a SpaceX Falcon 9, or they have to delay recognizing the revenue on those massive contracts.
So a delay in Neutron doesn't just hurt the launch segment. It bleeds into everything. It effectively kneecaps the revenue recognition of the space systems segment and delays the cash flow from the Iridium acquisition.
It creates a compounding negative effect across the entire vertically integrated business model. And that is why the market is so incredibly sensitive to any perceived delay in the Neutron timeline and, why retail investors are obsessing over rocket tape.
Makes total sense now.
The hardware progress is the only leading indicator we have for future cash flows. Rocket Lab has successfully used its $1.53 billion equity raise to buy its way into the top tier of defense primes. But the real test moving forward isn't acquiring assets.
Right, it's execution.
It's whether they can successfully operate a global communications constellation in Iridium while simultaneously debuting a brand new medium-lift rocket in Neutron. Can they manage two massive operational pivots at the exact same time without burning through their newly raised war chest? That is what every investor needs to be watching.
Make sure you follow the show for your daily earnings coverage. See you on the next deep dive.